taxes so that they can use some of that to actually fund properly designed whole life insurance contracts for the infinite banking concept. And this is oftentimes a subject that is a little polarizing to people because they think, oh, it's a loophole, or you're going to get in trouble, or I don't want to take advantage. I like paying taxes. Any one of those uh, situations could be 100% applicable to the way people feel about this. But if you actually look at the tax code, which the only way that taxes can actually be collected is through a series of laws the that Congress actually passes. So if you look at the tax code as being a series of incentives that the US Congress has put in place to drive the behavior of the American people, then you might look at this in a different perspective. I was first exposed to this by Tom Wheelwright, who is Robert Kiyosaki's CPA. And Tom actually does a whole series of educational videos and books on the fact that the tax code is simply a series of incentives that Congress put in place so that they get the behavior that they want. Now, that behavior, we could argue whether that behavior is beneficial to everyone. And I doubt if anything's ever going to be beneficial to everyone. But that is the way that a lot of people look at it. They say, well, this isn't benefiting everyone. It's only benefiting the rich. And to that, I would say that it's interesting that, they classify the rich oftentimes as the top 1%, and it's only benefiting them. Well, if that's true, and 1% of the population is rich and they are voting, then how is it that people continue to vote in people then that have an idea that tax mitigation or tax incentives are better for society in whole? In other words, if it was only benefiting the 1%, they wouldn't have enough votes to vote in the people that are actually championing these tax mitigation strategies. So that's just a food of thought to think about, that tax mitigation is actually driving the behavior of the American people. And one of the ones that people think about all the time is how interest from a mortgage can be deductible on your taxes. That is driving people to look at and see if purchasing a home actually is beneficial for them and their family because they're going to get a tax break. Now, what's interesting about this is that it used to be a lot more of a benefit before the 2017 Tax and Jobs Act by the Trump administration, because a lot more people were itemizing their deductions before that. After that, the Tax and Jobs Act was actually trying to actually mitigate well, not necessarily mitigate, but simplify the way that people are preparing their taxes. And so what they decided to do was up the standard deduction that everybody gets and eliminate the exemptions. So what they really did was give everybody much more of a standard deduction. And so that went above the uh, the itemized deduction in many, many cases. I don't remember the numbers right now, and don't quote me on this because I'm not a CPA. and I did not look up this number, but I remember when it first came out, they thought it would help about 80% of the people not be able to, or they didn't need to actually itemize anymore. And so that's an example of one way that people are actually using the tax code to actually benefit them so that they can get that Congress can drive the behavior that they want. And that behavior is to buy more houses. Because when you buy more houses, not only does the direct housing industry that builds houses actually have more jobs, but then everything that goes inside of those homes actually have more jobs. And although I think we're not going to dive into this today, you're also building some wealth inside the home, which it's actually trapped. And we talked about this on other videos, but that particular wealth building is actually from you making and paying down your loan and paying principal to increase your equity. We can talk about whether that's a net benefit or not. But if you do get a tax deduction, that would be savings on taxes. And that savings on taxes then could be used to fund into a whole life insurance policy because that money has to sit somewhere. And we've talked about this on this channel a lot of times that the infinite banking concept is simply a cash management tool for you to become your own banker, and money has to flow. So you can either keep it in somebody else's bank who's benefiting either the private people at the bank or a public entity, or you could use another financial institution, which is a life insurance company, to actually store your money there and then borrow against it that cash value whenever you need to take a loan. And thus, when you do that, you're not interrupting the compounding of any premiums you put in, and you can control the banking function. And whoever controls the banking function will control how wealth is being built. My wife and I were driving the other day, and we were just mesmerized. We were on the corner of two major intersections, and all four corners of that intersection was actually a bank. And my comment to her was, this has to be profitable, or they wouldn't build these physical buildings in a time where everybody is doing things online. I don't quite understand why there is still a need to build physical banks, but obviously they're very, very profitable, and that's why they're doing it. So that is that is the first one we want to talk about was how Congress is actually using incentives to get what they actually want, the behavior they actually want. So we now that we've established, and we've established one example, we're going to go over a few more. Secondly, when you look at this, as we continue to explore this, there's two basic tax codes in the United States. One for W-2 individuals, people that are just working a normal job for somebody and getting paid a paycheck that goes onto a W-2 and it has to be reported. And then there is one for business owners, whether they're sole proprietors, whether they're an LLC, whether they're a partnership, whether they're an S corporation, a C corporation, etc. And if you think about that tax code and how can you get into that tax code? So that tax code would require you to use your imagination, like Nelson said. The infinite banking concept is an exercise in imagination. So how can you as a W-2 employee actually become a business owner? And there's a variety of ways you can do that. And one of them is what Kiyosaki has espoused for all these years, and that is to get into some type of real estate. But that doesn't mean you couldn't actually do some other retail store. You could do some online businesses, but something that you're proving to the IRS that you're attempting to make money. And when that happens, then you can start to use the tax code on the business side, not just the W-2 side. So let's talk about a few business deductions that you may benefit you so that you pay less in taxes. So the first thing is why did Congress want us to have different tax codes for business owners? Well, that actually helps build businesses. And when you build businesses, you help then bring in more employees, and those more employees then will have jobs. And when you have jobs, then you have more um, revenue for the government. Although I disagree with all the taxes, but that's why they're doing it, is now they have more income for the government. That income tax, they also will have other taxes such as sales tax from the sale of things. So they're going to incent you to start a business by giving you some tax breaks. So you may pay less in taxes, but you're the one taking the risk. You're the one who is putting on all the extra time. And thus they're saying we were going to reward you with some tax breaks. When they reward you with tax breaks, you're more likely to take a greater risk because now you're going to have less capital that is at risk so that you can now employ more people and so on and so forth. So that is why Congress actually incents people to start businesses. So the first one, or the first thing I like to say is you don't have to get fancy to start a business. A lot of people think, well, I have to start an LLC and I have to have a business account and so on and so forth. No, you can simply, there is no formal way to start a business. You can simply just say, I'm starting a business as sole proprietor. Yes, you may have some local and some state requirements as far as business filings and uh, things that you really should do, like buying liability insurance and so on and so forth. But as far as starting an entity like an LLC, that is not necessary. You can just be in your own private name. There's some there's some benefits in not doing that, but let's just take the difficulty out of it. So you're a sole proprietor. So in order to do that, then everything that takes you to run that business is now a deduction in the eyes of the IRS. So a couple things that a lot of people miss, especially when they're just starting a small business out of their house, is home office deduction. And that home office deduction is given to you because you're saying, hey, the IRS is saying, hey, if you didn't do the office out of your house, you'd have to go and purchase an office um, in a commercial building. So we're going to allow you then to write off the square footage. We're going to let you write off, a restroom, the hallway to the restroom, so on and so forth. Now, what does that literally mean? So let's say you have a 3,000 square foot home and you have an office that is dedicated, has to be dedicated to the business. That is 300 square foot. So that's 10% of the total square footage of the home. So everything you needed to run that home, the mortgage, your insurance, your taxes, your electric bill, all your utilities, internet service, if you need television for whatever it is you're doing, maybe you're in finance and you have to keep track of the ticker tapes. Also, an office building is going to be required to keep it really nice. So then mowing the lawn, so on and so forth. You are able to write off 10% of that off your taxes, relatively off your income then. So that is the first one that I think a lot of people miss. Now you need to clear this with a tax professional. I'm just giving you kind of the overview to inspire you to look into this. Your cell phone. So the best way to do it would be to have a separate cell phone for business with a separate number. But a lot of people that's kind of a pain, and you can actually now have portable numbers in your cell phone, so you can have two numbers for one cell phone. And, if you're taking orders from people, or if you have to schedule your employees or businesses, contractors, whatever, it's a legitimate expense. Now, the IRS may say to you, well, but how much are you using for personal? How much are you using for business? You have to establish maybe some type of percentage and use that percentage. All right, the next one, vehicle expense. So a vehicle, you can actually take just the miles that you use for business purposes only, not for personal use. And you need to keep track of that. There's many apps that you can do this. You can do it on a spreadsheet. You can do it on a calendar. Just write when you are going to a business type of venture. It could be simply driving to deposit money in the bank. It could be driving on site if you're a real estate person. It could be obviously driving if you're going to have a meeting with somebody. All those miles are tax deductible in the eyes of the IRS. Meals. Once again, check your accountant. But if you're traveling um, for this and you have to stop to take a meal, that should be 100% deductible. If you are meeting a client and paying for a meal, then 50% of that is actually deductible. So just keep those kind of things in mind. Um, there are some things as far as clothing you can do. There's some restrictions on that. You want to talk about to your tax professional on that. There is also things like advertising that you may do, any type of printing for things that people may need to understand your business better. All those things can be written off the revenue before you actually get a profit. So the strategy is to see if you can reduce your taxable income through all of these and then redirect those tax savings into a policy in the form of premium payments. So that is the basics of starting a business. Okay. Now that's the basics. Now, if you want to once your revenue gets up further and once your net profit gets up further, then you're going to want to talk to a tax professional to see if you need to start a LLC or switch to and being taxed. You can start an LLC, but you have to then tell the IRS how you want to be taxed. Do I want to be taxed as a partnership? Do I want to be taxed as a sole proprietor? Do I want to be taxed as a C corporation or an S corporation? In most cases, if you're relatively small, an S corporation would be the best way to actually be taxed as a small business owner. And the reason for that is you're going to draw a salary from your S corporation. So you're going to actually set that salary, and the IRS says it has to be a reasonable salary for the job. Now, you're going to run into many CPAs that are going to discuss what reasonable is. I think you should get the opinion of several CPAs to determine what reasonable is, maybe even a tax attorney. But what is it that you would have to pay somebody? This is the best explanation I've ever was ever told. What would you have to pay somebody to do the job that you're doing to run your S corporation, to do the hiring, to do the bookkeeping, to do the bids? What would you have to pay that person? And that would be a reasonable salary. Anything above that, anything above that would then be taken out as a dividend distribution. Now, why is this advantageous? So let's just say you determine the reasonable salary was $100,000. So you would pay income tax just like your W-2 income person, and you'd have to pay Social Security and Medicare tax. Because you are also the employer, because you own the S corporation, then you'd also have to pay the Social Security and the Medicare tax and the income tax as from the employer. Well, you don't have to pay the income tax, but you have to make sure that gets filed. Those are bookkeeping expenses. Now, because you're paying both sides of it, now the break that you get, both sides of Social Security, the self-employment tax, the break you get is anything over that reasonable salary in the form of a dividend, you do not have to pay self-employment tax on it because it wasn't earned income, it was investment income because you got a dividend from the investment. So that's going to save you 15+% in taxes. So if you made another $200,000 on that above your salary, then that obviously would be another $30,000 of savings because you didn't have to pay the 15+% of self-employment tax. That $30,000 of savings could then be used as a premium payment. So this isn't something you want to do on your own. You want to get a tax professional's advice on this to set it up properly and make sure that you're taking a reasonable salary. All right, the next one. Now you started a business and you're trying to redirect money that you would otherwise receive to a more advantaged tax situation, which is perfectly legal. And one of them is to actually employ your own children in that family business. Now, it has to be legit. Okay. You can't just say they are working in your business and they don't work in your business. So, an example, you might have it has to be something reasonable. So, could a 12, 13, 14-year-old actually do filing for you? Could they do cleaning around the office, so on and so forth? I think that would be reasonable to say. Now, other things that I had clients do quite often is when they're advertising or when they're setting up their website, they're going to need pictures, and they want to have pictures of family in those, so they actually pay their children as models in their advertising. Now, we all get the concept now of paying your children, but how is that actually helpful to save taxes? Well, presuming that you're successful in business, and if you're in the W-2 paying job and you are in business, or your spouse is also W-2, then your taxable income would be X. Your children would have to file a tax return. But because the standard deduction for a single person is approximately $12,000 during the making of this video, that means you could pay them up to $12,000 if they earned it. You could subtract the $12,000 as a business expense. So then, thus, your taxable income comes down by $12,000 and presumably a higher tax rate. And then your child would get to write off $12,000 of standard deduction. So that means they have income of $12,000. They subtract $12,000. Their taxable income is now zero. So let's say you're in the 32% tax bracket. You shift that business money to your kids, and as long as you stay within that 12, and heck, even if you go over, now the first tax bracket is 10%, the second is 12%, you're still coming out ahead. I started this several years ago with my own father. We have business cards for him, and he hands out my business cards when anybody is looking for an insurance or for a financial advisor. And so we pay him to do that in our business. And he's in a lower tax rate. And now that the 2025 tax bill is eliminating taxes on Social Security, he'll be even in a lower tax bracket in the coming years. So it makes perfect sense to switch some of that tax liability to your father. Many of you might be saying, yeah, but you can understand how you do it for your children, because now your children are actually going to take that savings, or you're going to do it for your children, take the savings, that $12,000, and now you can deploy it into a whole life insurance policy for your children. Or you can keep some of them in the bank and just help them with their cash flow awareness, how money works. But that's a place that you can get some premium that has been not taxed at all. My father, you might be saying, now wait a minute, that doesn't make any sense. Your father now has that extra money where you would have had that money. Well, I've talked about this in other podcasts. I've actually taken a life insurance policy out on my father. So my father now can use that extra money, and I can use the tax savings to actually fund his policy, which I do. And thus, when he passes, and he's going to be 86 this year, and I hope he lives to be 103, because as the whole life insurance stays in force, it just gets larger and larger and larger. And then he'll be able to pay back all those years of me giving him a salary with his tax-free death benefit. So you can do it on, your parents also, if you'd like to do that, if you set up the entire process with it. There are some other things like that are very advantageous, like health savings accounts that you could do as a W-2 employee. And that health savings account, you can actually, there's a maximum you can put in every year, but that maximum actually goes against your taxable income. And that taxable income, then whatever you save on that could actually be used for some current or future premiums. Health savings accounts, some of the bad things about it is you are tying your money up. You're not necessarily getting a great rate of return, but you're saving on taxes, which is a great rate of return. And you can take it out tax-free as long as you use it on eligible medical expenses. So it's the only real thing that you can do to reduce your taxable income and then remove it tax-free very easily. There's other things you may be able to do some other strategies where you can offset it, but it's really kind of the number one thing that works like that. Reduce your taxable income, access to tax-free very easily. The last thing that I wanted to talk about before we got into some more complicated tax situations is real estate depreciation, and thus a subset of that are turbocharging it is called cost segregation. So once again, Congress realized that when a person purchases something is that they're using in their business, a piece of real estate, for example, that they're using for office space or to store business equipment, so on and so forth, that particular building actually depreciates parts of it. Parts of it are depreciated in value. And how do you know that? Because you have to replace a lot of those parts. You have to replace siding. You have to replace windows. You have to replace HVAC, flooring, wall coverings, even doors after a long period of time. Anything that is in there except for the basic shell of the building. And they will allow you to depreciate it over a certain time period. Now, that obviously then can be taken off your taxes. Now we have some passive and active, whether you're a real estate professional, we won't get into that today because there are some rules that you need to go over with your CPA or your tax attorney with on a personal level. But you can actually take it off your income against any of the income. So let's say you have a $1 million building that you purchase it for. They're going to let you divide that up according to the schedule that has been established by Congress at that time. And then you simply take whatever that is, divide it by the number of years, and you get to write that off. So it's like a paper loss. Why is it people say it's a paper loss and not a real loss? Well, it's because you haven't really taken any type of loss that year. What Congress is saying is eventually you're going to have to replace these things, and so we're trying to incent you to buy this real estate by allowing that sting of replacing these in the future. Now, one of the greatest things that Congress put in not too many years ago was what's called cost segregation. Because what people were saying is, well, wait a minute, this is great, but I don't, this is a long schedule. So I'm not getting very much, and I'm having to replace these things a lot sooner than normal. The building we're in right now, we've had to replace several air conditioners after only 10 years, and instead of 30 plus years. So Congress then said, well, yeah, you're replacing a lot of these things, and at a lot less than 30 years. So we're going to let you actually segment out portions of the building that you would have to replace a lot sooner than the 30 plus years. And we're going to let you pull that forward into one big deduction early. Now, just to give you a little hint here, I've had people do this and they love it. We had one particular business owner in California who was facing about a $260,000 tax burden. And we did cost segregation on several of his commercial buildings. And we pulled a lot of that future depreciation forward. And so he not only did he not have to pay the 260, he now actually got a $160,000 refund. Now, some people, CPAs, even CPAs will say, oh, I don't like doing cost segregation because you're actually taking away future deductions from depreciation in the future. And that's true. That's absolutely true. However, because we're eroding the buying power of our money, money today is worth more than it's going to be worth 10, 20, 30 years from now. So why not get that money today so that you can use it to build even more wealth that maybe can outpace the depreciation of our money. So that's why you would consider doing it. And of course, any of that savings, that $160,000 savings right there, that person could have used it to fund premiums in a particular whole life insurance contract. Now, what's the downside of that? And we won't get into this totally, but this is why you have to talk to your tax professional. When you sell the building, you either have to put it into another building, or you have to recapture all your depreciation that you've taken up previously. Now, that's not necessarily a bad thing because the current depreciation interest recapture percent is 25%. So you have to recapture that 25%. But if you were saving at the upper levels, the 35, the 32%, then you still came out ahead. Okay, so I think you can see the benefits of real estate depreciation and cost segregation that actually can then be used to fund current or future premiums for whole life insurance. The next thing you might consider is if you have what they call tax deferred money, or what they also call in the industry qualified money. And tax deferred money is simply, I'll just give you a few examples: 401ks, 403bs, 457s, IRAs, tax deferred annuities. And in other words, you have agreed that you're going to take a tax deduction now, and you're going to let the tax deferred money grow into some time in the future, and you're not going to pay taxes until after 59 and a half in most cases. There are some exceptions. We're not going to go into that right now. For 59 and a half in most cases. And at that time, you're going to pay the tax rate at that time. In the current tax law, most people are going to have to start taking money out, whether they want to or not, at age 75. That's called required minimum distributions. Working up to that, there's some people that don't have to take, or have to take it out even sooner. But right now, for the most time in the future, it's going to be age 75. Now, we don't know what tax rates are going to be at that time. And you're going to continue to take that required minimum distributions out over your lifetime. Now, the Secure Act by the Obama administration, excuse me, the Biden administration, they actually changed what happens to those tax deferred accounts when they go to the next generation. There's two types of beneficiaries for these tax deferred accounts. There is a spousal one, and as long as the spouse is not 10 years or older or younger than you, 10 years or younger than you, then your spouse can inherit the tax deferred money. And now they're going to take it out according to their age for required minimum distributions. But they are going to have to take it out whether they want it or not. The second type of distribution is called a beneficiary IRA. That goes to anybody that's not your spouse. In most cases, it's your children. So when your children receive it, the Secure Act 2.0 has clarified that you must take 10% of the IRA out over 10 years, not over your lifetime. You used to be able to stretch it out over your entire lifetime. So let's say you received it at age 45, you could then be taking it out over your entire lifetime. So a small amount. Now you have to take 10% out a year. And I tell people that could be very problematic because if your parents die of normal mortality, late 70s, let's just say 80 for easy math, and they had you when they were 25 or 30, so 30 from 80, it means that you're now 50 years old. You're in your prime earning years. So now whatever you make is going to be taxed, and 10% of whatever you were given as a beneficiary IRA goes on top of your earned income or your investment income or your income from a business. So it's going to be taxed at a higher rate, more than likely. So then what can happen for strategies is you might say during my lifetime, I want to not see how much taxes I can save in 1 year. I want to have a strategy where I can save taxes over my lifetime. So then you might actually start taking money out of your qualified plans and repositioning it somewhere so that you're paying the taxes that you know you have to pay, and you can actually take it before it goes into another tax bracket. So in other words, let's say the 22% tax bracket was up to and I'm just making these numbers up because they're constantly changing, but let's say it's up to $150,000 of taxable income, and you're at 120,000, and you know you're never going to be below 90,000 going to the lower tax bracket. So you're at 120. The next tax bracket doesn't go up until after 150,000. So you have $30,000 of room in that tax bracket before you go to the next tax bracket. And you're never going to be in a lower tax bracket. So one thing you may do so that you can reposition money and pay the known tax rate now is, and actually lower your taxable liability into the future if it continues to grow tax deferred, is take another $30,000 out. Now, you've paid you have to pay the taxes, but now you have to make a decision. Where am I going to store that money? Would I put it in a savings account, money market, CD? Well, you could, but now anything you earn there, you're actually going to have to put on your tax return in the future. So you're repositioning it for the tax return in the future for more taxes. You could put it into a brokerage account, and that wouldn't be necessarily bad because under current tax law, any money made in a brokerage account is only realized if you sell at a gain. If you don't intend to sell, then it gets passed on to the next generation under current tax law, which what they call a step up in basis. So let's say you buy a stock at $50 a share. That's your basis. It grows to $100. If you were to sell it, you'd have to pay $50 a share of taxes at capital gain rate. However, if it grows to $100, it grew $50 a share, and you pass away under current tax law, which Congress is thinking about getting rid of this, but under current tax law, it goes to the next generation. And now the next generation gets a step up in basis. So now instead of it being $50, it's now the dollar amount when you died, $100. So now they don't have to pay any taxes if they were to actually sell the stock. And or if it grows after that, they only have to pay the amount over $100. So you're trying to make a decision. Where do I put this money? You could put it in a life insurance contract, a whole life insurance contract. So this is another place to get a premium. So now you reposition it to a whole life insurance contract. You get all the benefits that we've talked about on this channel for years, using whole life as a cash management system to implement the infinite banking concept. But one of the greatest things you get is it actually grows tax deferred, but you can access it tax free up to the cost basis. And then loans are never taxable under current tax law. So that is a way that you could use the tax code and actually taking more money out, even though you're not required, so that you actually lessen your future tax liability, and you actually put it into a place where your children could benefit, because now they're going to get a death benefit instead of a tax deferred account. Tax deferred accounts, they have to take out in 10 years. Death benefit, they get it completely tax free. So that's a consideration. Also, putting it in there, now you have access to it in the form of a policy loan, and you can use it for other investments or vacation. And I've had some of my clients who would not go on vacation because they didn't want to take money out of their tax deferred accounts and have to pay taxes, but they'll borrow against their life insurance contracts so that they can go because they don't have to pay taxes. So it's a win-win situation. Okay, the final thing I'd like to talk to you today about is actually doing Roth conversions. So it's similar to what we just talked about, but now you're going to put it into a Roth IRA instead of a life insurance policy. I'm not sure if that's the best for everybody, but it is a possibility. We actually did a podcast years ago calling whole life insurance a rich man's Roth, because you actually can phase out of if you can do a Roth IRA or not. It's different every year. It gets indexed. So I'm not going to talk about what that number is today, but it's well over $200,000. So if you can't do a Roth because of your income and you want to do a Roth IRA, or if you just simply want to pay the taxes now under the known entities of the tax brackets, then you could simply do what they call a Roth conversion. So you pay the taxes and you put it into the Roth IRA. Now any of it actually grows tax free now in the Roth IRA. Now the downside is you have to pay the taxes. So you have to, maybe you do it over 1 or 2 or 3, years, depending on where you are in the tax bracket. This is why you have to actually get with a tax professional. We actually have our own tax office at E3 Wealth that we use to see if it's going to be beneficial or not. But now, as it grows in the Roth IRA, you have future premium that you could use for your whole life insurance contract. Okay. Now let's just pretend that you're going to do a Roth conversion. You got $500,000, and over the next 10 years, you're going to do $50,000 a year into a Roth IRA. But you're like, I don't even want to pay taxes on $50,000. So you can offset that with other tax mitigation strategies. One is, we've already talked about it, you could do cost segregation. That would be one thing you could do. You could offset it with oil and natural gas partnerships where you get an intangible drilling cost. And by the way, that's been in the tax code since 1913 because Congress wanted to incent us to be energy independent. So they actually give what they call intangible drilling costs, which is an expense of the partnership. So you could, let's say you do 50,000, you could then take money from another account. You could then put it into a oil or natural gas partnership. And in the conservative side, you get about 70% of that premium or $35,000 of that 50 that you put into the oil partnership, $35,000 as a write-off on any income. So when we do the Roth conversion, $50,000 increase in your income, but now you get to write off 35,000. So now you only paid taxes on 15,000 of the Roth conversion. And what's the interesting thing, after it's seasoned for 5 years, you do that several times, you could actually now start taking your Roth and you could do investments into other things that could get you some tax breaks. The final thing that we like talk about on Roth conversions is that it is a possibility where you can invest in things where the net asset value of that particular investment would come down according to IRS regulations. The easiest and greatest example I can give you is a developmental multifamily apartment complex. So you have a multifamily apartment complex partnership. They pool money together. You can use qualified money or tax deferred money. They actually obtain land. They start building. An IRS auditor comes out and says, okay, this is all legit. We're going to use conservative rents. You don't have any rent flowing yet. We don't even know how successful this is going to be. So we're going to actually assign a value to this whole project based upon conservative rent flow and conservative occupancies. And so your $100,000 investment may be discounted all the way to $70,000 on paper. You can then Roth convert at 70,000 and you could split it over a couple of years. So you only put $35,000 in your taxes. They continue developing the real estate. They then have a more success than the IRS auditor thought they were going to have. And they actually lease it for more than they thought it was going to. And your net asset value can actually double or maybe go 2.5 times above what it did in about a 5-year period. But now when they return your money to you, the partnership, it went from 100,000 in an IRA, paying taxes on 70,000, maybe split over 2 years, and now it goes to 200 to 250,000 in 5 years, but now it's all in a Roth IRA. So these are just different things we wanted to talk about today on how to actually use the tax code to fund your whole life insurance processes for premiums, because you really need to have a good understanding of your financial picture so that you can fund things properly in the future. I would like to close by saying that you should not be attempting any of this on your own. You should find and interview multiple CPAs and or tax attorneys, because what I found over my career is not everybody, not every CPA, it's not that they don't interpret the tax laws, because they're pretty black and white. They're not gray. But what I found is CPAs tend to be very conservative, and they frankly don't want to take any additional education to their clients. And they always claim they don't want to throw up any red flags. And I always say, well, wait a minute, it's right here in the tax code. What red flag are we throwing up? But I don't blame them. You know, a lot of times they're working very hard during the tax season. They get sick. and they don't want to work outside the tax season. So if anybody does get audited from their office, they're going to have to work outside the tax season. Even if they're getting paid, they really don't want to work outside the tax season. So make sure you look for a CPA that works mainly with business owners, or they do a lot of Roth conversions, and interview several of them to make sure that everybody's on the same page. So I hope this helped you try to find some additional premium for your whole life insurance. And remember that success leaves clues. So model the successful few, not the crowd, and live a life and business that you love. Until next time.